The Vanguard ETF, ticker symbol VGT, has absolutely obliterated the returns of the S&P 500 over the last decade. It has a total return of over 500% during that time frame. To put that in perspective, if you were to invest $100,000 into VGT 10 years ago, that would be worth $545,000 today. And if you were to put that same $100,000 into the Vanguard S&P 500 ETF, ticker symbol VOO, that's VOO, you would have $225,000 over the same time. And I'm fired up about making this video today because VGT is my personal favorite investment. And it's also 1/3 of the weighting in my modern 3-fund portfolio that has outperformed the S&P 500 for each of the last 10 years. In this video, we'll discuss what VGT is and why it's making a whole bunch of people very wealthy. But first, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. So what is VGT? VGT is the Vanguard Information Technology ETF. It seeks to track the performance of a benchmark index that measures the investment return of stocks in the information technology sector. It's passively managed using a full replication strategy when possible and a sampling strategy if regulatory constraints dictate. And it includes stocks of companies that serve the electronics and computer industries or that manufacture products based on the latest applied science. VGT has 325 holdings and has a very low expense ratio of 0.10%. How is VGT managed? Well, as I mentioned earlier, VGT is passively managed. Vanguard Information Technology ETF seeks to track the investment performance of the MSCI US Investable Market Information Technology 2550 Index, an index of stocks of large, medium-sized, and small US companies in the information technology sector, as classified under the Global Industry Classification Standard. Who should buy VGT? And before we dive further into this one, I just want to put out a reminder that this is not financial advice. Please do your own research before making an investment of any kind. I think VGT is a great investment no matter where you are in your investing journey. There's always room for a quality, high growth basket of stocks, which is the ETF. And it has a long track record of positive performance. And I really don't see technology taking a back seat looking into the future. However, it should be known that VGT is a roller coaster. It goes up and it goes way down. It goes way up and it goes way down compared to VOO, the S&P 500, and SCHD, the growth dividend ETF from Schwab, which are the other 2 funds in my modern 3-fund portfolio. With SCHD and VOO, there's really no such thing as screwing up your allocation. If you're retired and you're looking for cash flow now, you could go 100% with SCHD and no one would think you were crazy because it has such good, consistent growth on both dividends and the price over long periods of time. And then you can always go VOO. You know, the Warren Buffetts of the world plan on throwing all their money in, like 90% of their money into VOO someday when they're not actively managing their own funds. VOO you can't really go wrong with in SCHD. And while VGT has dominated the returns of both SCHD and VOO over the last 10 years, over the last 20 years, although SCHD hasn't been around that long. But when you look at any long stretch of time, VGT has outperformed them. But it does so in a very volatile way. Just as an example, in 2022, the total returns for VGT were negative 30%. So far this year to date, as I'm recording this video, the total returns are almost exactly positive 40%. So, you know, you're going up and down like crazy, and the dividends don't add up nearly as much as something like SCHD, which is in the mid to upper 3s on dividend yield, whereas VGT is well below 1 on its dividend yield. Now, if you're far from retirement, I think VGT is a great holding for your portfolio. Really, I would say you could put anywhere up to 50% depending on your age, your investing horizon, and your risk tolerance. But as I mentioned earlier, it is a roller coaster that goes up and down, but over long stretches of time, it has had dominant returns. So really it's about staying the course and dollar cost averaging into VGT, which just means putting a set amount in each week or each month without trying to time the market and without worrying about the price. And don't get too emotional when you see VGT going down, because every time you're dollar cost averaging in, you're getting more shares for each dollar. You're getting a bigger bang for your buck. Now, if you're retired and you're needing more cash flow now, it's better to mix in more SCHD within the 3-fund portfolio. But even in that case, I'd recommend having at least about 10% of VGT, because you probably have plenty of years left and VGT will very likely grow. So while you want more SCHD to get that cash flow, you'll also want some VGT because it'll give you some impressive growth long-term to ultimately make decisions such as buying more SCHD or putting more in a CD or a treasury bill or other options that you'll have in retirement. All right, now we're gonna jump into the return history of VGT, and I'm gonna share my screen for this one. I've pulled up VGT on Seeking Alpha, and I'm gonna start on the charting tab. We're looking at total return here. And so far, year to date in 2023, about halfway through the year, the total return is up 40%, which is pretty bonkers. And if we click over to the 3-year chart, on total returns, you're at 62%. This is where you start to see that roller coaster we were talking about earlier. But if you stay the course and keep dollar cost averaging in time, this thing will go up. Let's take a look at the 5-year, you're up to 153%. And over the last 10 years, VGT is up 555%. That is just insane. And just for a little perspective, if we select, let's just go with VU, which is the market, the S&P 500, which is an amazing investment, it's up 228% over that same time horizon. As you can see, they trend somewhat together, which is typical of the market. More volatility with VGT, but if you stick with it, it goes up. And although VGT is not a dividend ETF by any stretch of the imagination, if you look at the dividends, it's actually not too bad. When you go to dividend growth, you can see over time, VGT has increased its dividend payments for the most part. It didn't go up 1 year, so I think it broke its streak. Let's check that out here. It did, so it has a dividend growth streak of 0 years, but in the last 5 years, the dividend growth rate goes up 12% per year. So those dividend payments, although it's a low yield at 0.7%, and the purpose of this fund is not to get dividends, but they do add up. All right, now that we've looked at the basic return history for VGT, let's jump into one specific scenario to show how this would have added up over the years. Here I'm using the backtest functionality on the Portfolio Visualizer website. And what we're doing here is we're taking the last 10 years and we're including year to date. We're going to start with $10,000 in each fund. We're going to contribute a fixed amount of $500 a month, and we are going to reinvest dividends, yes. So a realistic scenario to show just how powerful the growth of VGT is over a long stretch of time when you dollar cost average in. And we're going to compare it to the S&P 500, which is VU with Portfolio 2, and SCHD, our quality dividend ETF, which is 100% over here on Portfolio 3. So if we run the analysis here, let's take a look at what we end up with. So VGT is here on Portfolio 1, and you can see your final balance with the above scenario would be $213,000 compared to $131 with the market and $125 with the dividend ETF. You can see that the best year was the highest on VGT, which we would expect, and the worst year was the most disastrous, which we also expect. If we look at the portfolio growth, VGT pulls away from the other two as more time goes on. And the other two are locked in a battle here. It looks like the market has recently taken over in the last 10 years from SCHD. They've been battling back and forth. So when we look at the annual returns year by year, you can see most of the high years are the best with VGT, which we would expect, but you also get a really bad low year when you're down almost 30% like 2022. So that's the part where you just got to stay the course with this thing. And if you look at the full time frame on annualized return, which is a pretty important metric, this is your CAGR. This is what the S&P 500 has been around 10% over the last 100 years on total return annualized, and it's been 11% over the last 50 years. And for our 10-year stretch, The market has been performing very well at almost 12%, SCHD a very solid 11%, and VGT almost cracking 20%. All right, I hope that gave you an idea of the power of VGT and how it compounds over the years. Please let me know in the comments if you buy VGT currently, or if not, what is your preferred growth ETF or growth stocks? Let me know what you put your money into. I think it's time to wrap up this video. Thank you so much for watching. Please give this video a like, hit the subscribe button if you haven't already. If you're enjoying the content, tell a friend about it. It'll help spread it, and I really do appreciate you so much. Have a wonderful rest of your day, and I will see you here next week. Peace.